Okay, so let's wrap this up. We had a number of sections talking about the specifics, the objectives and constraints of QU. Then we spent a lot of time dealing with liquidity issues and how important they were for the firm, for QU to deal with. Well, now we're going to get into the issue of asset allocation, and we're going to get into some issues about rebalancing. And remember, this QU actually has Quinco has a lot of external managers. That's who manages the portfolio funds. So they're going to have to pick some new investment advisors. And I love this case because it literally goes through the whole process from initially understanding objective constraints all the way to building the portfolio and then rebalancing and making changes. Okay, so a little bit more data. So now they're getting into asset manager selection. So several months later, the process of hiring some more external PMs to implement this new increase in alternative investments has begun. So an RFP, request for proposal, for private equity managers was issued, and they got some responses. One of the responses came from Gen X Venture Capital, GVC, and they have a proposal to invest in a new venture capital fund called GVC Fund 2. Okay, now this is where it gets interesting, and remember, I want you to start thinking about ethics. Ethics isn't something we just read about in the material. It happens in the real world, and this case is very real. So ethics becomes an issue. So guess what? GVC, the venture capital firm that they're considering giving some money to invest for them, is operated by Virginia Hall, who is actually on the QU endowment board. And on top of that, she has been highly supportive in terms of money and effort to the university. So both the university treasurer and the president are strongly in support of GVC's proposal. And not only have they in support of it, they've told Winter about it, and they've indicated their support. Now, Winter, on the other hand, believes that Hall has asked the two individuals in advance to support her proposal. So this is not very good. This is a potential ethics violation as well. And what I want you to realize is we're going over the case details and we're looking at this at a 30,000-foot level. You've got to take it to the next step. Look at the Kaplan questions. What information are we expecting you to glean from this? And take a look at the CFA Institute material about what they're looking for in these cases. You have to test yourself. Make sure you're getting the right points and learning the right lessons. That's why this is so valuable. Okay, so the two finalists that were selected from the request for proposal were GVC and Beecher Venture Investments, called Beecher. So GVC and Beecher, they're both going to have to present to Quinco's investment committee. Now, Jason Allen, and you're going to find this in real world too. The financial industry, we all know each other. Everybody works with each other. It's very much a small world. Well, that's what happened in this case. Jason's a former colleague of Winter, and he's the one that's giving the GVC presentation to Quinco's investment committee. Now, interesting, Winter knows that his presentation contains confidential information possibly obtained from the university treasurer. Another potential ethics issue here. The other thing that popped up that was interesting, so GVC's historical returns, they're presented with amounts that are materially greater than are reported elsewhere by third parties. That's something odd that I would want to look into a little bit more. And Beecher is seen as the more established choice, despite some problems with the performance of its previous fund. Now, to be fair, some concerns were also raised about GVC's short existence to date. Now, ultimately, Bud Davis, he's one of Quinco's top portfolio managers in private equity, so he's asked to make his recommendation. Now, David states that GVC is finding it difficult to raise their $300 million for their Fund 2, and Fund 1 only raised $100 million. So the investors are worried about this threefold expansion, and quite honestly, it's uncertain if GVC can achieve its goal. Now, interesting, this kind of got my attention. Davis tempers that point with strong positive comments about GVC's manager and investment approach, and he confirms that GVC's investment management fee will be lowered if they're selected. Okay, so what happens? Under Davis's recommendation, the investment committee agrees with David and GVC is selected to move forward with their venture capital fund. So Winner speaks with Alan, and during the conversation, Alan states that Davis's spouse, Andrea, is Hall's daughter. This is getting even more intriguing. It's almost like a soap opera. Do we have some ethics issues here? When Winner confronts Davis with that information, Davis says, hey, come on, it was well known. And he assumed that everyone on the investment committee already knew of this relationship. Without a doubt, this is a conflict of interest. And did everyone on the investment committee know about this? Because Winter didn't, and I would want to investigate that a little bit further myself. Okay, the other thing that the board did is they approved a much longer active risk budget for Quinco in their tactical asset allocation plan. So the annual tracking error limit was increased from 100 basis points to 250 basis points. Remember, so they thought the expected returns were going to be going down, so they had to take more risk in order to get more returns, so they're allowing some more latitude, and that's a pretty significant increase in tracking error. Now, Winter and staff are now responsible for implementing this new tactical asset allocation plan, and they have the authority to use 150 basis points of this 200 basis point budget. So again, that's a lot of latitude, and now they've got some work to do. So because of the use of derivatives in the implementation, they're worried about increased leverage, which is a very reasonable concern. So the board approves a maximum leverage position of 5% of portfolio value. So again, very common, max 5%. Winner thinks that the tactical asset allocation plan is going to allow weighting positions in acceptable asset classes and also allow investing in assets beyond the policy portfolio benchmark universe. And it's still going to be suitable with the IPS. I'd want to see some more work on this. Okay, in implementing the plan, Winner starts with fair value. What's fair value? It's an intrinsic value. It's what he thinks fair value is. And then he's estimating mean reversion in his fair value models for the portfolio assets. And using relevant economic and financial data that's known to have predictive power, they're used to estimate future risk and return for periods ranging 1 to 3 years. Okay, well, you guys know right off the bat, models change. Things that worked in the past might not have predictive power in the future. So again, I'm being a little skeptical. I want a little bit more information, and maybe I would want to dig into this a little bit further too. So output from the models, again, the theoretically correct fair value model is going to be compared to actual prices and see if there are any variances and are they large enough that we can exploit them. Hey, and guess what? When they back tested, it revealed the models worked well. Surprisingly, back testing normally does reveal models work well. Unfortunately, just because you have a successful back test doesn't mean it's going to work in the future. And you also have to be careful of data mining. If you wanted to, you could make the growth of a Christmas tree correlated to the stock market. It takes about 7 years to grow a Christmas tree. About 7 years is an average historical period for the stock market. So therefore, a back test would show me that a Christmas tree can predict stock returns. I'm not so sure I'm going to buy that argument. There's got to be some economic theory behind that. Okay, and then we find that large cap U.S. equities are priced far below their fair value, and mean reversion would occur in about a year. So not only are they pretty sure there's mean reversion, but it's going to occur in about a year. Wow, I wish I could have done that as a portfolio manager and made those predictions. So it sounds like to me here, we might be having some behavioral finance issues. Maybe overconfidence, maybe even gambler's fallacy. Seems to be popping up here a little bit. But again, you've got to work at the material, work at our quiz questions, work at the CFA material, see what types of questions you're going to be asked from this data. I'm just sort of giving you a couple of things that kind of come to my mind. Okay, so Thompson, that lead analyst, uses this information. So therefore, let's go ahead and overweight U.S. equities by 1% using total return swap or equity futures or ETFs. So what is the objective? I want to minimize the use of cash and transaction cost. So her team comes up with a summary shown in the following table to help Thompson make that decision. So let's look at comparing investment cost. So we have ETFs, we have futures, and we have total return swaps. And this is in basis point cost. So we can see with the ETFs, we're going to have about 35 basis points. Futures, we're going to have about 42. And total return, we're going to have about 51 basis points. Okay, so Thompson feels that, okay, well, that might be so, but ETFs require too much upfront cash, so 100% of the value, and you can only margin 50%. So on an 80 million investment, we're going to have to put up 40 million in cash. Now, if we use futures or total return swaps to obtain that 80 million exposure, we can do this for far less cash than using the ETFs. So again, ETFs and futures are liquid. They're widely traded and they have low transaction costs. Also, both instruments allow for early termination should the market conditions warrant to get out of it, and Thompson values flexibility. Now, in contrast, total return swaps are traded over the counter. They're negotiated, they're customized features, and they're not very liquid. Okay, so there's not a lot of flexibility here. Also, with futures, Thompson states that she doesn't like the daily margin and having to deal with that. She also states that she has concerns over interest rate and counterparty credit risk. Now, the derivatives overlay is going to be performed using a leverage ratio of 4, meaning 25% of the investment is cash, 75% will be borrowed. Now, finance costs are going to be based on a 2% 3-month LIBOR rate for futures and swaps, and there's an additional 0.5 financing cost for ETFs. So let's go ahead and dive into this asset allocation rebalancing. So it's now 3 months after the overweight position in U.S. equities, and the position's done well. Now, fixed income has not performed well due to the large rise in interest rates. So they've noticed a noticeable drift in the asset allocation. Now, here's how they handle rebalancing. So rebalancing is going to be performed quarterly for cost control reasons. Okay, I would buy that. Makes sense? And portfolio drift from the strategic asset allocation is going to be checked on a monthly basis. Okay, I've got no problems with this. That's fine too. Okay, at the end of each quarter, if a relatively liquid asset class moves outside that corridor, it's going to be systematically rebalanced back to either the target allocation or to the edge of that corridor. That's kind of an interesting point. I might want to dig into this a little bit more. So for more illiquid asset classes, high transaction costs, yep, that's going to happen. They mean that rebalancing is going to be done more implicitly, and they typically alter the commitments and reinvestments when allocations drift to either end of the corridor. So it's not as easy to deal with that problem. Now, the way they're handling it, I think that's a reasonable strategy. Okay, so let's look at the information that their team put together. First thing that I would want to look at here, I would want to take a look at the target asset allocation. And then I want to basically see where are we in regard to the current allocation. And then I want to take a look at this corridor. And I want to see the minimum and maximum targets. So as you look at this, okay, cash was 1%. It can go 0 to 2%, for example. If we look at private equity, it can be 23%. It can go 18 to 28. We're currently at 19%. If I look at international developed equity, target asset allocation is 9. We can go 7 to 11. We're currently at 11.5. Okay, that might be one we want to look at. We're outside that quarter range. Okay, same thing again. We can look at real assets. Target asset allocation is 16. We've got a range of 13 to 19. We're at 13.8. We're kind of on the low end there. And then we can look at diversifying strategies. Same thing. We've got a minimum max target of 12 to 18. We're kind of at that higher range. So just a few things that jump out at me. And when you take a look at fixed income, target asset allocation is 9%. We've got a range of 6 to 12%, and we're at 6.5%. So we're pretty close to that lower range too. So this is what I mean. It's important to be able to analyze these tables and glean the information that you need. This is data. It doesn't mean anything until you put it into a meaningful concept like I did. I took the target asset allocation or the strategic asset allocation. I took where the current position was, and then I checked the quarter widths, their minimum maximum target, to see where we needed to make some adjustments. Okay, so based on her analysis of the previous table, let's see what Thompson notices. International developed equity at a current allocation of 11.5% exceeded the top end of the quarter. We saw that. Fixed income at the allocation of 6.5% is way off from a strategic asset allocation of 9%, but it's still within the range of 6 to 12%, but it's sure getting close to 6%. Okay, private equity at a current allocation of 19.2% is near the low end of the quarter at 18%, and real assets at a current allocation of 13% is near the low quarter of 13%. So what does Thompson decide? Immediately, as an immediate action, Thompson wants to reduce the international developed equity allocation and increase fixed income by 0.5%, taking the former back to the top edge of its corridor. Okay, the only question is, how are we going to do this? Are we going to use a cash market, or are we going to use the derivatives market? So she's aware that if we implement this, it's going to take more time in the cash market, but she said it's necessary for larger or more important adjustments. Really? I think derivatives might be able to do a pretty good job also. But again, more things to think about. Okay, Thompson finds that the 0.5% rebalancing transaction over a 3-month investment horizon is going to incur 30 basis points of transaction cost in the cash market. So we've got a bid offer spread of 5 basis points, a price impact of 5 basis points, and then we have this cash drag issue of 20 basis points, which gives us this 30 basis point transaction cost. Okay, now that same 0.5 rebalancing transaction will only incur 24 basis points in the futures market. Let's break that down. So we've got a bid offer spread of 3 bips, we've got a price impact of 4 bips, and we've got mispricing of 17 bips. Okay, now we've got our 24 bips. Okay, so Thomson goes ahead and rebalances the international developed equity to the strategic target allocation of 9%. It involves a 2.5% decrease to equity and a 2.5% increase to fixed income. The investment horizon is 1 year, and they're going to incur 60 basis points of transaction cost in the cash market. Where does that come from? We got a bid offer spread of 5 bips. We got a price impact of 5 bips, and actually a fairly significant cash drag of 50 basis points that sum up to our 60. Okay, so the last thing, we just talked about how she's going to make this allocation from equities over to fixed income. And we saw in the cash market, there's a 60 basis point cost. Well, what happens if we do that in the futures market? Well, what we see, there's actually an 82 basis point cost to do that. And the majority of that, it's coming from the cash drag. And then we've got a cost of rolling futures, which actually is not too bad at 6 bips, giving us this total at 82 basis points. So we've spent 78 slides roughly going through just setting up this case for institutional investing for QU. Now, there were a lot of moving parts and a lot of pieces, but the one thing that we really didn't do is dive down into the questions. I spent a lot of time, mentioning and talking about some things that I thought were interesting, but it doesn't really matter what I think is interesting. What matters is what the CFA Institute thinks is interesting. So again, I cannot stress enough, go back and work the problems, work the quiz, go through the CFA Institute material, get familiar with what you need to know out of this very lengthy case. This is a wonderful summary of everything that we've covered really in this program. I think the case studies in institutional portfolio management and private wealth management that we're going to do are actually a great capstone for the CFA program and a great study aid. So again, we covered a lot of areas of this institutional portfolio manager case, extremely realistic, and a number of learning areas and nuggets that you need to ferret out to help you be successful. So again, don't give up. I know this is a lot of work. I know there's a lot of things that were presented in this case. It was extremely complicated, but guess what? That's the world that you're going into. Sometimes things aren't that simple. If everything was so simple, there'd be no reason for you, and there wouldn't be any money in it. So keep studying. Let's knock this out. Let's make this the year that you get your charter.